the majority of everyone on the call tonight, I pretty much have seen you guys in course group on the Facebook alumni page or in the Discord group. And just like many of you all, I came up through the Abacus as well. Started out going through the Abacus, learn how to trade calls and puts, learn some chart reading skills, and just simply started trading calls and puts, just straight options, back to back. And yeah, it did me good sometimes. Sometimes it did, sometimes it did not. We all know that you can have a very good day trading calls and puts, and then the very next day, you can have a terrible day. Sometimes it could be like you could just get back all the gains that you had simply because of the time decay, implied volatility changing up on you, just all those different things. So as I was trading, and it's been about I want to say about 6 years now. But as I was trading, I started hearing and reading about option spreads. I will always see net debit or net credit, and it was talk about option spreads. Never truly knew what it meant, but I took a stab at it, tried to figure out what it was. Still couldn't understand it. So back to the calls and puts I go, trying to get better at that. And I, just like everybody else, have had these instances where you could be in a good trade, you could be up on it, you could be rubbing your hands together, and the next thing that you know, the trade go completely against you and you lose your money, okay? We've all been there. We've all held on to winning contracts overnight and then wake up the very next morning and that contract is back in the red. Every trader that trade options have been in all these different situations. So I just knew that it had to be a better way. And then I started to read that a lot of other professional traders, they actually trade spreads. So guess what I wanted to do at that point? I wanted to learn how to trade spreads. Did a lot of reading, did a lot of research, watched a lot of YouTube videos, tried it, lost money. But over a period of time, me and my team, we figured out how to trade these spreads. And that's what I'm going to show you guys tonight is some of the benefits, all the cons and pros that you will get from trading these spreads. I'm going to share my screen here. And we're going to get started on, if my screen up accurate, and we're going to get started. Okay. Can everyone see my screen?
Yes.
Okay, good. Spreads, you guys. This is going to be an introduction to spreads, to option spreads. Talking about how to actually leverage those regular calls and puts that we trade on a day-to-day basis. But what is an option spread? What is an option spread? It is simply a strategy in which a trader will buy and sell multiple options of the same type. That could either be a call, it could either be a put. But it's going to be the same underlying asset. So it's going to be an Apple option spread or a Tesla option spread or a SPY option spread. It'll never combine the two together. That's not a spread. A spread is when you're taking that same underlying asset that you're trading and you're buying one and then you're selling one. They can vary in terms of strike price, expiry date, or both. And that's the thing that takes it from being a credit spread to a debit spread to another kind of spread as well. The way that you will structure those strike prices, the expiry date, or even both of those, all right? So option spreads, you're taking two contracts, either two call contracts or two put contracts, and you're putting them together and you're turning those two contracts into what we call a spread. Now, it's many types of spreads out there. Tonight, we're going to only talk about two, but there are many different kinds of spreads out there. So if you're doing your own reading and research on spreads, you might hear them talk about credit spreads. You might hear debit spreads, diagonal spread, calendar spread, ratio spread, iron condor, Then you got butterfly spreads. It just there are collar spreads. It's other spreads out there, but the two different kinds of spreads that makes up the building block, the foundation of all these spreads are the credit and the debit spread. I majorly trade the credit and the debit spreads. From time to time, I would trade the diagonal spread, but the credit and debit spread, those are the two that I run on a day-to-day basis. And those are the two that is the foundation for all the other spreads that you're going to ever come across. If you learn the credit and debit spreads, learning the other spreads is going to be a cinch. Those other spreads are going to be a cinch once you learn credit and debit spreads. But before we go further into the spreads, I want to talk a little bit about theta. Now, everybody on the call should already be option traders. A person can't learn spreads if they can't trade options. So if everyone in here came from Quartz Group, then I know everyone here knows how to trade options. But before we go into the spreads, I want to talk about one of the Greeks. That Greek is called the theta. The theta is going to be one of the main Greeks that you're still going to have to deal with theta when you're trading spreads, but you're going to be dealing with it in a different way. So before I go forward, I want to make sure everybody understands theta, because I traded options maybe for about a year and a half, and I fully didn't understand how that theta actually worked. And even now, I be doing consultations with people about options and spreads, and some of them still don't fully understand theta. And you got to understand theta if you're going to start doing, especially these credit spreads. So let's talk about theta for one hot second, all right? Theta, time decay. Theta represents how much the option price is going to decrease for every day that passes. So an option that has a theta of 0.25, and we all know that that means 25 cents. That option's price is going to decrease by $25 for every day that passes. So we all know that the further out that you go on your contract's expiry date, the less that your theta is going to be. But the closer that you get to expiry, the more that theta is going to be. So a contract can easily have a theta of 25, especially if it expires tomorrow or the day after tomorrow. So let's go through an example. You got Facebook stock, and it's traded at $215. Ooh, that was what, about 8 months ago, wasn't it? But Facebook stock is trading at $215. It has an option price of $100, and the theta on that contract is $25. So if you hold that option overnight and one day pass, if Facebook is still trading at $215, that the price of that option contract is going to decrease down to $75. Why? Because you're going to subtract the $25, that's the theta, from the option price of $100 down to $75. So now that option contract is only worth $75 because that theta, that time decay took a toll on that option contract. And we all been trading the options for a while and been holding on the contracts for days and days and days. And then it started creeping up on the expiry date, and those contracts just started diminishing a whole lot more, even though the stock is not even moving at all. So that theta is very important when you're dealing with calls and puts and the spreads. So I want to make sure that everybody got a full understanding of theta before we move forward and talk more about these spreads. The first one we're going to talk about tonight is going to be the credit spreads. And hey, everybody, if you have any questions while I'm going through the PowerPoint, simply type your question into the chat section and someone will be able to answer those questions. If I'm going too fast and you didn't catch something, simply type that question inside the chat to answer it. And if you want to wait till the end of the whole slide, then I can answer all the questions at the end, okay? So, credit spread. What are some of the advantages of credit spreads? The key advantage is going to be theta, you guys. Theta, at this point, when you're trading credit spreads, theta is not your enemy anymore. Theta is your friend. Theta works with you. Theta works with you when you're trading a credit spread. You no longer have to buy a contract and just watch the value of that contract diminish because time is passing by and the stock isn't moving. You could use a credit spread to profit from theta, from that time decay. That's the main benefit of using credit spread. You can remain profitable with neutral to moderately bullish, moderately bearish price movement. That just simply means that even if the stock is going, even if the stock is going against you, even if the stock is going against you, remember you still got theta on your side. So even though the stock is going against you, that option is still decaying in the process because you got theta on your side. It's not against you anymore. I can't stress that enough. When I learned that I could trade using theta on my side as a partner, that just changed the whole game right there. That's why I run those credit spreads. A credit spread can also benefit from the IV decreasing, implied volatility. We've all been in contracts. The implied volatility was high, and then the market settled down, the implied volatility went down, and there you go, left with a contract that just done went down so much in value, not because the stock moved in the opposite direction, simply because the implied volatility went down. So you benefit doing a credit spread, you benefit when the implied volatility goes down. These credit spreads, they require less management. So when we run these spreads, we don't sit there and watch this computer screen all day long, watching the charts all day long. When we run the credit spreads and the debit spreads, it just requires less management. Many days I have other things going on and I just can't sit there and watch that screen from 8:30 to 3 o'clock in the evening time because I have other things going on. And I'm pretty sure that some of you guys are the same way. You got jobs or just got other adventures that you got going on and you can't watch that screen all day long. When you run these spreads, it requires less of your time. It requires less of your time. That's one of the good benefits that I also like about these spreads. You can control and increase your potential profit by making adjustments to your contracts. So you got control over how much that you can make and how much that you can lose when doing these spreads. You can adjust the way that you put these two contracts together. It's not just a one spread for their one underlying asset. No, you can control how you group those together. Now, one of the disadvantages of a credit spread is your risk to reward can be fairly low. Your risk to reward can be fairly low. So that simply means that you can lose just as much as you can gain. Sometimes you can lose more than what you can gain. But all that comes from improperly doing your credit spread. Your profit is going to be capped. So with a credit spread, before you even get into the contract, before you even get into the trade, it's going to let you know what your max profit is, and it's going to also let you know what your max loss is as well. But there's going to be a limit on how much that you can make on that one credit spread. But remember, you make the adjustments, you put that credit spread together. So if you want to make $100 from that credit spread play, that's how you can put it together. If you want to make $1,000 from that credit spread play, you can put that together as well. You have full control over how you put these different contracts together and make what we call a credit spread. And the other disadvantage is if you do it incorrectly, you could get exercised early. Have anybody ever been accidentally exercised on a contract? Because if you have, you've seen how the balances on your screen go from green to red, and you might even have margin calls. I mean, just all kind of things take place when you get exercised. you can get exercised by your contract expiring in the money. So if you do a credit spread incorrectly, without the proper guidance, the right training, you can get exercised early, and that's just not a very good feeling. I've been exercised early on some credit spreads contracts early on when I first started doing it, and I had to figure out what happened, what to do, couldn't call anybody, had to stay on the phone with the brokers for an hour or two just trying to figure out what happened and how I cannot do this again. But that's just one of the disadvantages of it. But that's only if you do it incorrectly. So everyone, those are the advantages and the disadvantages of running a credit spread. I run these credit spreads maybe 3 or 4 times a week, sometimes even more than that, sometimes even 3 or 4 times a day. I've even scalped from time to time using a credit spread, simply because I know how to put those contracts together very quickly and profit from them and then get out of their play. So just like that, you could do a call and put if you're bullish or bearish. If you're bullish or bearish, you can still do credit spreads and do scalping and still benefit from those credit spreads. If you have any questions, place your questions in the group. I'm sorry, in the chat section. Now we're going to talk about debit spreads. Now, me, myself, personally, I like debit spreads. Sorry about it, put this phone on silent. I love debit spreads, and I run debit spreads a lot more than I run the credit spreads, because it has some benefits that I like, that I get to take advantage of on a day-to-day basis. So what's the main benefit of a debit spread? Lower risk with bigger reward. I'm gonna say it again. You have a lower risk with a bigger reward. So I could trade a smaller amount of money and I could get a bigger reward than I can if I did a simple call and put. And I'm gonna go into more detail about that a little bit later on in the webinar. But I get a chance to put up less money and could get a bigger reward. I could trade with a smaller amount with my day trades. So instead of doing a straight call and put on Apple or SPY or whatnot, I would do a debit spread, especially if I'm very bullish or very bearish. I'm most definitely going to do it then. But you get to trade with using a smaller amount of money. You don't have to put as much money on the line to make your trade. And I'm going to show you some details on that on down the line. With a debit spread, your contract can expire in the money and you can receive the maximum profit, unlike a call or put. And what I mean by that is, if you bought out the money call or put, say for maybe $30 or $40, and by the time that it expired on expiry date, you might get to being in the money, but that contract is only going to be worth so much because it took so long to get to that point. I know the majority of us do not hold our contracts just until they try to get in the money. We would have been sold them by then. But just know, with a debit spread, it could get in the money. It could be 1 cent in the money, and you can receive that maximum profit from that play. And remember, you will know what your maximum profit is before you even place the trade. I know some of this might sound kind of like foreign language, but I'm going to show you some examples in a moment, and it's going to help clear some of this up for us. Just like credit spreads, they require less management. And also, just like credit spreads, you can control and increase your potential profit by making adjustments to your contract. So if you want to make $200 off this trade, then that's all about how you structure that contract. If you want to make $1,000 from this debit spread trade, it's all about how you structure that contract. If you want to make $2,000, $5,000 from this trade, it's all about how you put those contracts together. And you will know your maximum profit and your maximum loss before you even place the trade. That's one of the good things I like about it. It may cap your income, but it might cap your profit, but at least you will know how much that you can make from that extra trade. and you have a higher return with the moderate price move. So if I'm very bearish or very bullish on a play, and I put a debit spread in, and it give me a very good move in that direction, especially with multiple contracts on the line, you will see that profit. You will see it running up in the green so fast, so fast. And also on these debit spreads. Now, unlike the credit spreads, on the credit spread, theta is your friend. Theta is on your side. But with debit spread, theta is still against you, but it has less of an effect on your trade. It's still not your friend, but it has less of an effect on that trade that you just made. So those are the benefits, those are the advantages of running debit spreads. Now let's go over to the disadvantages. The underlying security, the stock, will have to move more to profit than a regular call or put. That just simply means that as soon as you place that trade, if you place a debit spread and a credit spread, if you place a debit spread and a call or a put at the same time, that straight call contract or that straight put contract, it might start putting you in profit land faster, but with a good movement of the actual stock, that debit spread is going to outrun it. The debit spread is going to outrun it. So you need a little bit more of a movement on the stock in order for your debit spread to turn green, unlike you can with a regular call or a regular put. And your maximum profit is capped. So once again, you will know what your maximum profit is before you even place the trade. But you get to determine how you want to put that debit spread contract together. You get to choose if you want your maximum profit to be $200 or $500 or $1,000 or $4,000, or if you want your maximum profit to be 300% or 500% or 1,500% or 4,000%. You get to choose that by the way that you put that debit spread plate together. So those are the advantages and the disadvantages of the debit spreads. So now let me give you an example right here. Say that you just bought a call option on SPY. You paid $200 for that call option. You have a stop loss of 25%. So your maximum loss on that is going to be $50, give or take a little bit, okay, because of slippage or whatnot. But let's just stick to exact numbers right now. Call option costs you $200. You got a stop loss of 25%. So your maximum loss is $50. Now, they say that your maximum profit is unlimited theory, but you know, as high as the stock can go, then yeah, that call option is going to keep going also outside of the time decay hidden and before it actually gets to expiry date. So people like to say that they can go to infinity, that unlimited, but that's just in theory. But your max profit is on up there. Call option $200, stop loss 25%, max loss $50. Now, when you get stopped out, if the stock goes against you and you get stopped out, that trade is over. You lose the $50. The trade is over. It's dead. It's done. The only way to make more money the only way to make money from this trade is if you get back into another trade. But when you get stopped out, it's over with. Now, let's say you take a debit spread and you pay $50 for that debit spread and you don't put no stop loss on it. Your maximum loss is still only that $50 that you put up on the line. The same $50 that you would have lost if you got stopped out on the call option, you will lose that $50. That is your max loss. But your max profit can be as much as $2,000. Your profit is capped, but spending $50 and turning it into $2,000 is not a bad deal. And watch this. The debit spread can go all the way to zero, and it can still come back to life. That just simply means that I can get into this debit spread play, spend the $50. It could go completely against me, and now that contract is worth $50. Now, how many times have you been in a trade, a call contract? You got in it, it went the other way, you got stopped out, and it was like almost immediately as you got stopped out, the stock decided to turn around and go in that direction that you was right on in the first place. You was right about the direction, but you was wrong on the timing. And by you being wrong on the timing, you got stopped out and that trade was over with. But with the debit spread, if it go against you, you don't close the trade out, it sits there. Now when the stock decides to turn around and go that direction that you had originally said it was gonna go, now you could go ahead and get that profit that you was trying to get in the first place. So with the call option, you got stopped out, it's done, it's over with. There's no coming back. But with the debit spread, it could go all the way to zero, still come back and take you to profit land. And you do not have to get back into a fresh play. But if it does not come back, then you still only lose the same $50 that you would have lost if you had a straight call contract and got hit or stopped out at the 25% stop. That's one of the reasons why we like to run debit spreads, because we get to stay in the trade, because not all the time you're going to be right about the timing. You could be right about the direction, but you got to also be right about the timing. You get into that contract at the wrong time, it go against you, and you're mad. I know I've been there thousands of times. So, SPY. Let's say SPY is trading at $380, and we have an expiry date of August 19th. On expiry date, SPY is in the money. It's trading at $395 on expiry date. That's $15 up. You got a call contract. It costs you $200. Your strike price is $390. So by it expiring at $395, that means that you're $5 in the money. That call contract is going to be worth somewhere in between $1,500 to $2,000. That depends on how fast they get to the strike. It depends on how much time is left on the contract. It depends on how much that the implied volatility done went up or down. So just somewhere in between $1,500 to $2,000. So you spend $200. You got a strike price of $390. It expired $5 in the money. Contract is worth between $1,500 to $2,000. Now on the debit spread, you can spend that same $200 worth of premium and choose your two strikes of $390, $395. If that contract expired in the money, you could be somewhere around $4,500, $4,800. The same $200 that you would have got if you had did a straight call contract. And this debit spread, it can expire just 1 cent in the money. It don't matter if it got to the strike and expired there on the last day, at the last moment. It only got to expire 1 cent in the money, and you would get that maximum profit from that contract. So that's how you could look at these straight calls and puts versus the debit spreads and see why we run debit spreads versus calls and puts, because they got a lot more benefits than those calls and puts. Yeah, it's very exciting scalping with a call contract, jumping in, being out in 20, 25 seconds with a $200-300 profit sometimes. Yeah, that's exciting, but what about when it goes against you the other way? And now you're down $100 or $150 in what, 20, 30 seconds. It ain't fun no more, is it? But that's why we run those debit spreads. Now, we actually have a course that we teach these credit and debit spreads. We don't necessarily teach all the other spreads because, like we said, All the other spreads is going to come natural to you once you learn credit and debit spread. But these are some of the things that we actually teach in the course when it comes to the spreads. What happens when the option spread expires in the money? You need to know what to do and also what not to do. You need to know how to choose your contracts. You need to know how to enter your trade. All this is taught in the course. How to exit a trade, how to manage and adjust a spread trade, because you need to know how to put in that stop loss. You need to know how to put in that profit exit. You need to know which one of those spreads is going to allow you to do either or both of those, the stop loss and the profit exit, because you want to always take your profit, especially if you're not sitting there looking at it. So these are some of the things that we teach in the course. We teach about the spreads. We teach about selling options. We teach about how to put these contracts together to make that contract profit you what you're trying to profit. It helps you to achieve your goals when you're doing these spread plays. So here on the screen that you see now is a debit spread play that I did on Mara. Mara, that's Marathon. That's the option that, well, that's the company that tracks Bitcoin. So this option screen that you're seeing on my screen now, you see right here where it says Mara debit spread, and then there's 5 contracts, and you see the profit, you see the percentage, and all of that. This is how it's going to look. Well, this is dependent upon what broker that you use, okay? Because different brokers, their screen is set up different, and depending on who you're with, it could be easy to put these spreads plays in, and on some of them, it could be kind of hard, all right? But this right here is done on Charles Schwab. And let me explain this right here too, because I get a lot of questions about, can you do these spread plays on the cash account? No, you cannot do spread plays on the cash account. You got to have a margin account. You got to have a margin account in order to do spreads. And that margin account on some brokers like Charles Schwab, they're going to require you to have at least $2,000 in your account in order to do a spread trade. Now, some of us, like me, I was so leery about getting a margin account in the beginning because so many people told me to stay away from margin accounts. So I just did what they said, and I stayed away from margin account. Margin accounts are kind of scary when you trade things like futures, because just because you're doing $100 trade, that trade could go against you and you could lose $300, $400, $500. You could lose more than what you got on the line. But with the margin account for the spreads, you don't have to worry about that, because if it says that your maximum loss is $200, then you cannot lose no more than that $200. It don't go all the way into your margin and put you deep, deep, deep in the red like you would if you were trading futures or Forex or something like that. So don't let margin accounts scare you when it comes to spreads, but just know that you got to have a margin account. That's an SEC rule. You got to have a margin account in order to do spreads. And if you got less than 25K inside your account, yes, you are subject to pattern day trading. You are subject to pattern day trading if you have less than 25K inside your margin account. But in order to do the spread plays, you got to have a margin account, and you got to have at least 2K in there for most brokerages, okay? For most brokers. I think there are some like Webull, if I'm not mistaken, and Tastyworks. They will allow you to have a margin account, and you can do spreads with less than $2,000, but you got to have the funds in the account to be able to cover the trade. You got to have the funds in the account to be able to cover the trade. Here are some more examples of some of the debit spread plays that we have ran in the past, and just to show you that it is possible to take these spreads and do just as good on these spread plays, if not better, than you would or could if you was doing straight calls and puts. Here we have, I don't see the actual thing that we was trading on here, but it went to a 349% profit. Here we have 429%. I had to scroll back through a lot of my Facebook posts to find some of these pictures that I had. This is 530% on Tesla. I love trading spreads on Tesla, especially on Fridays. 712%. We have SPX. Now, from time to time, I trade SPX. Sometimes I trade SPY. I like to trade SPX. I guess it's just depending on how I'm feeling at the moment. But back in the day, I used to trade SPX a whole lot more than I traded SPY. But here's one for 887%. Another one on Mara for 856%. 915. What's this one? 953. 1100%. 1000%. You see this one right here on PEN, it shows how we paid $20 or 20 cents for those contracts, and they went to $2.28. Another beauty I like about the spreads, and this is the reason why we can let some of these contracts go up so high, because we're paying a smaller amount for the contract. So when you're paying $20 for the contract and it runs up to 40, 50, 60, 80, and the theta is not taking a big hard toll on the contract, hey, look, that allows you to hold on to these contracts just a little bit longer than you would if you was doing a regular straight call and put. Because you know, on this straight call and put, if it decide to turn around and go against you hard, it's going to take back all that profit that you just gained. Then we also have some bigger ones right here, like 1200%, 1500%. Zoom, this was 1800%. DocuSign, 676%. Then we got NVIDIA. Back when NVIDIA did that stock split last year in like June, NVIDIA went from about $560 a share to about $780 a share in the course of about 2 months. And we was able to get these cheap debit spread contracts and ran them all the way up to 2,600%. And here go Facebook. When Facebook took their hard fall at earnest, those contracts went to 3,312%. And we was able to hold on to these contracts because we did not pay much for them at all. And that's why the majority of the time, we like to buy multiple contracts. Now, by the time that we get a chance to take these screenshots, the majority of those contracts got sold, and we be holding on to some of the other ones as runners, okay? I like to hold maybe about 1 or 2 as being my runners. But just know that it is possible for you to make 1,000, 2,000, 3,000, 4,000 and 5,000% profit from running debit spreads. Debit spreads. And it's some more benefits that come into play. I like to teach my people sometimes that even if you are doing a straight call or put and you don't want to get subject to pattern day trading because you bought the contract that morning, did not think that it was going to put you in a position to sell that day, but it did. But you know, if you did sell it, you'll get hit with pattern day trading. When you know how to do debit spreads, you can take that contract, turn it to a spread, hold it overnight, give yourself 100% protection, and then get out of that play the very next day and still make the same amount of money if you had to close it out that very same day and not get hit with that pattern day trading. It's just so many different things that spreads give you the option to actually do with your trades. It's like you get to leverage regular calls and push. That's simply what it is. You're leveraging the calls and puts that you're already trading and giving yourself more and more options to trade with. It's almost like a plumber or a mechanic showing up at a job site. They're ready to do the job. They're not going to jump out the car and have their whole toolbox with them. No, they're going to get out, they're going to assess the job, see what's wrong, see what tool that he need, going to go back, get the right tool, come back and fix it. Trading is the same thing. You don't want to show up to every market with a simple call and put, because every market is not set up for a regular call and put. Sometimes you need to do a debit spread. Sometimes you need to do a credit spread because the market is going to be flat that day. You can't trade a call option in a flat market. You can't trade a put option in a flat market, but you can trade a credit spread. You can trade an iron condor. Why? Because they take advantage of that flat market. They take advantage and use that time decay in its favor. So that's what this webinar is about tonight. Just showing everybody how you could put more tools on your tool belt and do some more and better trading. And you don't have to always just be a one-trick pony with every trade that you do now. Do we have any questions, anybody? If you do, just raise your hand or unmute yourself. So everybody fully understood it? Mr. Parker? Did you get that, Mr. Parker?
Yes, sir. I'm right there with you.
Did you understand all of that?
Yep. It's pretty much what I had already kind of gotten a lot of this information from some of the research I did, and you just validated all of it for me.
Okay. And my aim was to make it simple, because when you're watching those YouTube videos, I feel like they try to talk circles around your head, and they like to use a lot of different names when they talk about spreads. They might talk about bull put spreads, bear call spreads, vertical spread, then you hear call spread, and then a debit spread. And at the end of the day, the majority of those are talking about the same thing. But that's where the confusion comes in at, because you're hearing it talked by different people, talked about by different people, and they're describing these things differently.
Yes, sir. That is a true fact for sure.
Yeah, and I think that's what took me so long on actually grasping it in the beginning, because I didn't have anyone to actually teach me these spreads. I had to try it, learn it, lose money, try, learn it, lose money. Then I finally got it.
Well, I have very little money to lose, sir.
Don't we all? Who wants to lose their money? But I just knew that it was a better way of trading other than just simple calls and puts. Because worst feeling in the world, and we all feel like that the market is aiming towards us when we get into that trade and it go against us, it stop us out, it take off going that direction. But now if you get back in, it's going to hit you with pattern day trading. Or now you just don't feel confident in that trade anymore. Or as soon as you get into it, that stock goes completely the opposite direction. Now you're losing on delta, you're losing on theta, you're losing on implied volatility. You got all these things going against you because you're using a straight call or put. When you're using a spread, you get to use some of these things in your favor, man. And that's what I like about them the most. And I just hate the fact how they keep it so confusing to us about what these spreads actually are. They're really not confusing at all. It's just that many of us don't have any form of training on it. And the people that do know how to do spreads, they're not really teaching it because they're too busy just doing it for themselves. But this is our way of giving back and actually teaching and showing everybody how to do these spreads. Let me check some of these questions that's in the chat. I'm pretty sure that they all got answered, but let me see. Someone asked, can you paper trade spreads? Yes, you can. All brokerages don't allow it, but if your broker do allow, if the broker do allow spreads and paper trading, then it will allow you to paper trade those spreads as well. So y'all, let me tell everybody about what you get when you join us, all right? So the price of the option spread course is $999. It's $999. The price has been going up and it's going to go up even further as well, very, very shortly. It's going to go up some more as well. Because everybody here is in course group, and me and Court have became good buddies, good pals. We talk, we chat all the time. I'm going to offer to everybody in the Mogul Stock Group for $849. So that's going to be from $999, it's going to go down to $849. And you also get 30 days free in the Discord chat group. Now, here's what you get when you're in the Discord chat group. Just like any course, just like any session that you may take, you can read it all, watch all the videos, but there's nothing like actually getting there, putting that trade in, and then seeing what happens. Managing that trade, getting out of that trade, just fully understanding everything that's going on. But you have access to us in the group, and you can talk to us in the group, ask us questions, and you'll even have the option to share your screen if you're stuck somewhere. If you can't get out of this trade, how come this contract is not filling to take you out? How come you can't get in? What's going on? Why is my screen saying this? Why is my screen saying that? That's what you get us for in the chat group. We don't send out alerts about the spreads, but we will help you to get in, manage, and do your spread trades. That's what you will get when you join the Discord group, and that's going to be 30 days free. Because the Discord group is going to be $149 a month. I recommend take the course, get finished with the course, then do your 30 days free in the Discord group, because that 30 days start the moment that you sign up for the free 30 days. We send out trade alerts, we get trade alerts, but for your spread trades, we're not going to guarantee that we're going to send out the spread alert trades, all right? Because I want everybody first to get in and get comfortable with putting in spread trades, credit spread and debit spreads, knowing how to manage them, knowing how to get out of those trades. You have access to all the channels in the Discord group. And you have access, well, this kind of goes along with the top line. You have exclusive access to the spreads trading zone and the advanced options trading zone as well. So you have access not only to just the spread channel, but you have access to all the channels as well also. So the course is $999. We're going to offer to this group for $849. And I promise you guys, please take advantage of it, because the price is going to go up. Prices go up, but prices don't always go down. Prices go up, but prices do not always go down. And the way we teach these spreads on the course is keeping it simple. We have screen videos showing how to get in trades, showing how to manage the trade, showing how to set your profit exit, get out of the trade. I mean, the whole 9 yards. The whole 9 yards. We go back to the chat and see what the other questions are. And when it comes to those paper trades, now, everybody in our group, we use Charles Schwab for our option spreads because of the way that Charles Schwab have their platform set up. It is so easy to navigate in Charles Schwab. I've seen other platforms that I don't like too much when it comes to spreads. I've seen Thinkorswim. I've seen Tasty. I don't like those. Some of the people in the group, they do use Thinkorswim and Tasty, and they love it. I also use TradeStation as well for my spread. I like TradeStation because TradeStation gives me a lot of flexibility, and it gives me more control over how I want to build my spreads out. So that's one of the reasons why I chose TradeStation to do a lot of my spread trades. But yeah, you can paper trade spreads depending on the broker. You can even do spreads on Robinhood. You can even do spreads on Robinhood. But I'm going to recommend everyone to do Charles Schwab because you could get more support from our group if you're doing Charles Schwab, because everyone in the group does Charles Schwab, and anybody in the group will be able to assist you with what you got going on those spread trades. Any more questions, anybody? Did that whole credit spread thingy and the theta confuse anyone, throw you off, or did not know that you could actually use that theta to your benefit? It didn't have to always be the enemy. That's what a lot of people actually use, that sell options. But the scary part about selling a naked option is it could give you what they call unlimited loss. It's like if you buying the option, the farther that the stock goes up, the more money that you can make. But if you just flat out selling that option and it's going against you, your loss is unlimited. So when you do spreads, it allows you to still be able to sell these options, but you can cap how much that you could actually lose on these plays. Questions, anyone? Because I'm not for sure how many more times that we're gonna do the spread video live going forward. It may be recorded. So I wanted to do it live with the group so everyone can ask these questions.
This was a great presentation, bro.
Thanks, Court.
Yeah, every time I see you do, I think this is what, the second or the third time I got to catch it, and every time I learned something different. I'm over here taking notes. Are you gonna make these slides available?
Yes, I will make these slides available, and I actually post them. I'll post them in the alumni group if you want me to.
Perfect, dope. So, and we trading together tomorrow morning. So awesome. I'm excited.
I'll be on it tomorrow morning at 7:30. Well, 7:30 my time. 8:30.
Yeah, I ain't doing shit at 7:30 on my side, but I look forward to trading with you guys, all of you guys on the chat. I know a few of you guys personally, but I'll let you continue. Thank you so much for having me. I really appreciate you.
Man, I appreciate you having me, Court. And Court actually been sending over some of those alerts from his group over to our Discord group, and we've been taking some of those alerts and running spreads on those.
Yes.
So
Lamadis taught me that that's the only way. I just crunched the numbers and went back and looked at some of my old trades and trading journals.
yeah,
And the debit spreads, the spreads is really the only way where it makes sense to trade around earnings and hold through earnings. You know, I get to eliminate theta, IV crush, depending on the position I take. And I couldn't be more thankful. We've done really well with it. We've had a couple hit 100%. Nothing that could fuck with the things that you just posted. I just saw one for 4,000%. Didn't even really understand how that was possible until you explained it here. And man, I couldn't be more grateful for you, you know, for just really pouring into me and adding to my tool belt as well. Thank you so much, man. I really appreciate you.
Yeah, Court, man. There's no problem, man. And we're gonna get together and dive a whole lot deeper into these
Let's
spreads.
do it. Let's do it.
Especially with them diagonal spreads I was telling you about.
Ooh, game over. I'm excited, man.
Yeah.
And that strategy that you've been back testing for almost what, 6 months to a year now?
Yeah.
Can't wait for you to break that out. So
I gotta show it to you, man. I gotta show it to you.
Please, I'm gonna come see you soon. I'm gonna come out there and we're gonna definitely dive in person. I can't wait.
Sound good, man. Sound good. So,
my brother. Mm-hmm.
So everybody, if you have any questions, please ask your questions. Don't leave tonight and feel like that you got to go jump back on YouTube to try to get some of these questions answered, because I'm right here to be able to answer these questions for you. Well, with that being said, then, hey, Court, I'm gonna see you on in the live channel tomorrow morning, and I'm gonna post these slides on the alumni page, and I'll probably even go ahead and upload it somewhere in the. I'll just send it over to you, Court, and you can upload it. All right. So everybody, you all can reach me on Facebook. Follow us on Facebook. My name is my name, Lamartus Woods. We got the Facebook page. We got the all the links for the Facebook page and the website and everything is in the chat section. Also, there's a coupon code to get that discount for the course from $9.99 to $8.49. There's a coupon code that we placed inside the chat section. So please get that there. Yep, I see it right here. The coupon code is going to be 100 off. So as you're signing up for the course, you just simply type in that coupon code in the coupon code section, and it's going to automatically discount it down to the $8.49. So follow us on Facebook, Instagram. You can follow my personal page. And if you have any more questions, just hit us up somewhere in the chat section and we'll get those questions answered. All right. I'll see you guys shortly.